Welcome back to Alex Lavender on YouTube, and we have a very special guest here today. And I want to introduce Steve MacLellan. Did I pronounce that right?
In the East Coast, MacLellan, but anywhere else, you nailed it just perfectly.
Perfect. And Steve is a dad of three, husband of one. He's a recovering engineer and is now a financial engineer. And he is the owner of Design Your Future Financial Services. He's also the award-winning author of Grow, Control, and Keep Your Money. He helps Canadians keep more of their hard-earned money instead of giving it away to taxes, high fees, and losses, so you can focus on what's truly important in life. And Steve is specifically here today to answer all of our questions on the Smith maneuver. We had a lot of people comment on the last video that Alex and I put together on the Smith maneuver. A lot of questions, so we decided, hey, we got to bring in an expert, someone who really knows the ins and outs of the Smith maneuver. So Steve, welcome to Alex Lavender's YouTube channel. Please give people an introduction. If I missed anything, please fill us in and we can get started.
Hey, thanks a lot, Mark. Honored to be here. And I am the financial engineer, not a financial engineer. And yeah, just in my former life, engineering, and brought that kind of engineering mindset and tried to work on my personality to the financial services.
That's lovely. And so Steve, the financial engineer, please break this down for me as if I am a 5-year-old child. Please tell me, what is the Smith maneuver?
The Smith maneuver is really, it's not that complicated. In Canada, we have debt that is either tax deductible or non-tax deductible. And the Smith maneuver is simply taking that tax deductible debt, or the debt that is not tax deductible, and switching it into a different pocket where it is tax deductible. So where this really became popular back in the 80s, Fraser Smith had an idea on like how can he really increase his financial services, and he realized there was a loophole because in the States the interest on mortgages were tax deductible. They were not here in Canada, and they still are not here in Canada. And that's one of the reasons why there's almost a big life gap, or a quality of life gap between those Americans that are doing well versus the Canadians. There's also a reason why there's such a difference between the have-nots and the haves in the United States compared to Canada. We're much more of a socialist country. But one of the benefits of the Smith maneuver is you can now take your mortgage, which is not tax deductible, and convert it to a tax deductible debt. Was that simple enough?
Yeah, that's really simple. And I want to put some dollar figures behind this. So could you give us a rough estimate, like what sort of tax savings does something like this, result in for the average person making your mortgage tax deductible?
Well, let's just use an example, keep it really simple, a plain Jane Smith maneuver, where it's simply, if you had a mortgage for $500,000 and you had investments of $500,000, right now that mortgage is not tax deductible. And the investments, if they're in the open, let's say they're averaging a 5% return, and we'll just keep it really simple. The mortgage is 5% rate of return. So generally you're paying $25,000 a year in interest on that mortgage, which is not tax deductible. And if all those investments were interest based, and they'd be taxed again when it works out, that 5% gain is about $25,000. So you're kind of breaking even. Actually, you're paying a lot more tax. So if I'm to break this down, sometimes discussing numbers, I get too deep into the weeds. But to make it simple, with that non-tax deductible mortgage, you're paying about $25,000 a year in interest. You're making about $25,000 a year in your investments, which are being taxed. So you're switching this over. All you're simply doing, if you're doing the plain Jane Smith maneuver, was selling your $500,000 worth of investments, paying off your mortgage, then remortgaging, usually with the home line of credit, and putting that $500,000 back into the investments. So it's not changing your net worth at the moment, but what it does is now that $25,000 you were paying in interest is now tax deductible. And the average Canadian, unfortunately, pays 41% in taxes every year. So you're looking at a tax deduction of $10,250 approximately every single year. So saving 10,000 every year over 10 years, that's a savings of 100,000. And that's really the power of the Smith maneuver. It's just having that extra savings.
And over the course of a mortgage, this could really end up being like hundreds of thousands of dollars of tax savings. Is that right?
Even in the plain Jane example, if I just showed you, that $500,000 and you didn't put another cent into the investment, but you just paid the interest off that mortgage, that compound interest in that investment is growing and growing and growing. And if it gets a 5% return, you're roughly doubling that money in about 15 years, where you could pay off that mortgage with one lump sum. So it does make a huge difference down the road, as long as the investments continue to go up.
Okay, that's amazing. Yeah, the savings is like really, really huge. And especially with Canadians, I think everyone nowadays is talking about how much taxes they're paying. And so being able to reduce your taxes by like $10,000 a year is literally huge. And even if, like you said, you might, be breaking even on your investments versus your mortgage, the tax savings could even be making it worthwhile for you. So I want to understand this really like a before and after. So right now, let's say for myself, I have a mortgage on my home and I'm interested in the Smith maneuver. Right now I just pay my mortgage off. It's relatively simple. What does that new product look like? And maybe Alex is as a mortgage broker, like you might have some insights here too, because I know you've helped some people with this.
Not the majority of Canadians, unfortunately, do not have 500,000 in their investments. So you can start off this smaller, and this is what the Smith maneuver, actually is getting it's a re-advanceable mortgage or a line of credit for your property. Now, I'm a big fan of home line of credits for a lot of reasons. It actually offers a lot more control and you have access to your cash when you need it. But with the re-advanceable mortgage, what this does is every time you pay off the conventional portion of your mortgage, as Alex, right now, when you get a home line of credit or advanceable home line of credit, you still have a portion that is the conventional mortgage. In Canada, it's roughly, you got to put at least 20% down, and it seems to get a little tighter. What do you normally see is the minimum Canadians can put down? Is it still 20%?
Oh, you're on mute, Alex.
Here I was trying to do the headset and fancy. So the minimum down payment you can use is 5%. But when we're doing the Smith maneuver, it gets into a home equity line of credit situation. And the biggest line of credit that you can have is 65% of the value of the home. So typically Smith maneuver is going to be, or a line of credit is going to be reserved for people that have an equity position of 80% of their home, because 65% can be a line of credit and 15% can be a term mortgage component to get you to that 80%. So when you have this 80% equity in your home, that when you're mortgaging 80% of the home, that's when we can look at doing Smith maneuver. The reason why we've seen a big rise in this over the last couple of years is because property values have gone up significantly, and now people have a bunch of equity in their home, and they're exploring ways to, try and use this as an investment and pay down their mortgage quicker, or look at tax strategies, which is something we haven't really seen before in the past because house values went up so, at a very much slower pace. So yeah, in the realm of things for home equity line of credit, it's going to be 65% of the value of the home is the max that you can extract.
So if I understand that right, Alex, you need a 20% down payment in order to be eligible for a Smith maneuver. Is that right?
In theory, yes, because a home equity line of credit product is not going to be available until you have that 20% down. So that's what's going to open the door. So typically, if you're someone maybe buying a home with 5% down, this might not be something that you're going to do right away. This is something you maybe want to plan for 5 years down the road when some equity is built up. This product is very popular, and a lot of people have been reaching out for people that have existing homes that they've had for a few years, where there is a bunch of equity in the home now built up. That's typically, the people that are reaching out. Someone who maybe bought a home for, let's say it was $300,000 in 2020 with a $200,000 mortgage, and now that home is worth $700,000 with the same, $150,000, $200,000 mortgage. There's a ton of equity there, and they can draw a big portion of that on a line of credit. to use for something like this.
Okay. So if I understand this right, then step one, we turn our regular mortgage into a two-part mortgage, one that has a, what did you guys say, readvanceable and conventional part to it. So we've done that. We've turned our mortgage into a two-part mortgage with the readvanceable and the conventional. What do we do next?
I couldn't have said it better myself. So generally with the readvanceable mortgage, when you are paying down the conventional portion, the line of credit increases. So you're putting money into the conventional mortgage. That line, then you're taking that line of credit is increasing. You're taking that and putting it into a set investment. And I'll go over the investments that apply for this, because not all investments work for this kind of strategy. So it's not really taking your cash flow. It's not taking any money over your cash flow. It's just going from point A to point B, where you do that on a monthly basis. So your mortgage, your conventional mortgage is going down. Your home line of credit is actually either staying still or going up, while your investments are going up. And looking at a long-term asset, at the end of the year, you are going to be paying taxes on the capital gains and interest from the investments. But you're also going to get the tax deduction from the interest on that line of credit. If you do get a tax refund, the beautiful thing is you can put them then back on the conventional mortgage. Then that increases your line of credit once more. Then it goes into your investments, and you just repeat this process year after year.
And I can give an example from a mortgage point of view too. And the tricky thing with this is it's scenario specific, right? So it gets kind of tricky trying to generalize a lot of this. But just for a second, imagine you had a home worth, let's say it's $500,000. Let's say you have a $400,000, or let's say a $300,000 mortgage on it, for example. So if it's worth $500,000, the highest you can go to is 80%. So that's $400,000. Let's say you have a $300,000 mortgage now. So if we did a home equity line of credit product, we have $300,000 currently as a mortgage, and then $100,000 available on a line of credit. So that $100,000 could be used to invest into Smith Maneuver assets right off the bat. And as you pay down that $300,000, it becomes available on that $100,000 line of credit. So $300,000, you pay it down to $275. Now you have $125 available on that line of credit, and it just continues to grow up to the maximum the line of credit can be, which is 65% of the house value. So that means that line of credit can go up to $325,000. Then once it reaches that, that's the maximum as per government rules. So that's kind of just a real life example on how a mortgage would kind of look into something like that, I would say.
So Steve, you mentioned that we put these into investments. Can I take the cash out of my HELOC and put it into like a TFSA or RSP?
No, unfortunately, you cannot. So anything that grows tax-free is not considered an investment that would qualify to make that interest tax deductible. So that's your tax-free savings accounts. That's your RRSPs. That's a properly designed whole life policy. And if the investments only produce a capital gain, they're not qualified either. So that would be your cryptocurrencies, most stocks. But stocks with the dividend, they qualify. Real estate that you're renting out, that would qualify. That's actually one of my favorites. I use that more so than other investments. Your ETFs and mutual funds that provide interest and dividends, they also qualify. They would have to be in a open account. Also, if you're running a business, you can run this, and that business is making money. You can, run some of your expenses through this way and then claim that as an interest.
That sounds very interesting too, and that kind of gets into that intricacies of this isn't a one solution fits all. It's very tailored. I didn't know that you could do it for real estate as well. So that's super cool. Like real estate, business owners can use it as well. So it can really be tailored to who it is. And I think from a mortgage point of view as well, I mean, if you can get in a scenario where maybe your mortgage rate is 4% and you have an investment at 8 or 9%, you can use that extra interest to really pay this down quicker. And it can help people get mortgage free a lot quicker as well by accelerating and paying down their mortgage by borrowing just to, get some extra income generated from their mortgage itself to pay it down quicker.
100%. If you're okay with, leveraged investing or using your mortgage as a asset where you can invest, you have a lot more control, and you could actually pay off your mortgage a lot faster if that is one of your goals.
And what's the end game here? Because I know we're increasing our line of credit and we want to pay off that mortgage, but that line of credit is increasing. So am I right to assume that, our end game, mortgage down to zero, we have a decent sized home equity line of credit, but also a decent sized investment portfolio, maybe a couple rental properties that we own? Is that the end game there, that those are then cash flowing in order to pay off the HELOC plus some more?
That is the end goal, that you can use your investments to pay off that line of credit at the end. Or, you make sure that if your demise comes, that all your assets will be able to pay off that mortgage. You have more control. And that's one of the reasons why I like the home line of credit, is because you have the ability to pay it off when you want, whenever you want, with no penalties or fees, versus, as you guys know, all the fees and penalties that come with paying off your conventional mortgage too fast.
And would you recommend that someone uses the entire portion of that HELOC in order to put into investments? Or is there like a safe limit of like only using 80% of your HELOC? What would you recommend?
I think that would be a person-on-person basis. I am a big fan of dollar cost averaging, so I wouldn't take that example of that 500,000 that I just talked about and throw it all right into the market. I'd probably throw it into a money market or a high interest savings account, and then cost average it out over the time. There's more than one way to peel a potato when it comes to the Smith maneuver.
And is there any particular, I know you said some investments don't count, like some stocks, I guess, and some cryptocurrencies can't put into your TFSA or RSP, that doesn't count. Is there anything else that doesn't apply?
Generally, if you just look at the CR website, it says anything, if it's only capital gains producing, it does not qualify. And as long as it's providing income, you're generally good to go. Okay,
got it. And is there a specific rate of return that someone should be targeting? Like if our mortgage or if our HELOC is, a 5% interest on the HELOC, should we be trying to get more than that from our investments? Or is it possible?
You should always be trying to get more. But the way the market works, you don't know. And the examples I show, like even if you break even, if the interest rate and your rate of return is exactly the same, you're still got a positive gain here because of the tax deduction. So you can actually have a lower rate of return and still come out ahead. The thing is, if this is all invested in the market, you're going to have years where it goes up and you're going to have years where it goes down. So you have to ask yourself, are you okay with going down? And another problem with the Smith maneuver, you are adding two more levels of risk. You're adding the interest rate risk. So could the interest rates go up again? I don't think so, but maybe. And then you're also adding the value of your home. Could the value of your home go down in the future?
Got it. And Alex, this will be a question for you. I know I've heard a lot of people talking recently about some HELOCs that are getting, adjusted, where they might have had 100,000 available on their HELOC, and their bank came back and said, well, now you only have 80,000 available. Is that still a risk as well?
Yeah, that's a risk. And that's also a risk at any time. So yeah, some banks, there are a couple particular banks out there that have been drawing this back a little bit. I think it's just an internal policy where they're trying to reduce the amount of credit available. So it's one or two banks in particular, really. As a whole, though, there is a rule that came out a couple of years ago where the 65% limit is shrinking on HELOCs. So you've got a couple things in play for sure, but I would say on an individual basis, the bank could come in and say, no more HELOC for you. We're gonna, bring down this limit. We want it closed. We want it paid out. Typically, that's something that they're going to run into when they have concerns about your borrowing ability, or there's some other concerns that have maybe come up. Maybe you're defaulting on other debts, or they have concerns about the value of the home, or whatever. But that is also a risk. I mean, at the end of the day, if you had a $300,000 line of credit that was fully drawn and you have it invested in assets, the goal would be, if you ran into any issues, you should be able to draw those funds back to cover it. The goal is to take that money, and still have that equity. It's just invested in assets.
Got it. That makes sense. So we talked about risks with the Smith maneuver on interest rates and those changing with the HELOC, with the rate of return that you're getting from investments. Are there any other hidden risks with the Smith maneuver that people should be aware about? Because I feel like I've seen a lot of people online talk about the Smith maneuver. Not many people talk about these risks. So is there anything else that we're missing?
Yeah, one of the things over this past decade, our government has really tightened the screws on taxes. CRA, they've really increased the amount of audits that are going on and happening. So you really have to make sure you have a good paper trail and keeping records. So if you do get audited, you can show exactly what's going on. The things that kind of keep me up at night is, the government recently introduced GAR, which is usually saved for, gangsters and big time crooks, where they can look at taxes for any reason. They're bringing that to the general public. And also there's the alternative tax, where CRA can redo your taxes, and they can decide which one they think is right and which one is wrong. So CRA seems to be, it's changing the rules and the goalposts. And that's another risk. Are they going to change the goalposts again? Or are they going to say simply, hey, we don't agree with this? And they're going to say, you owe us taxes. So keeping track of your numbers is very important.
Got it.
I'd say the biggest risk that I see, just if we're looking at it just from a mortgage point of view for someone, is you just have to be careful because it's your home, right? So like if you take 300 grand out on a line of credit and you're in a poor investment, or you're really I want to get 15% interest in something that's super high risk, and you lose those funds, that's going to be a big setback. Where this is attached to your home, it's not, just extra money that you have saved up and invested. This is, your house, which is people's biggest debt usually, and their biggest asset, and their biggest retirement saving asset as well.
Alex, you brought up a great point there. This is what I've learned through my journey is money is not just charts and stats. It is very, very emotional. So if you have a year's where the stock market is doing a big correction and you're panicking and you sell, you can lose a lot of money. And the other thing with home loan and credits, if you don't have a plan, I love them, but if you don't have a plan, you could have a mortgage for the rest of your life, right? And I've seen that happen, unfortunately, as well.
For sure. And there's a big drawback with the home. That's a great point Steve brings up as well. If the HELOC is not being used for Smith maneuver, or you have extra room available on the line of credit, that is something, I always check with borrowers to make sure that they're okay managing their credit as well. Because, if you have access to $300,000 on a line of credit, it's very easy to spend that money. Just being, it's much harder if you need to go in for an approval and refinance your home and take the equity out, compared to, we have 300 grand available. And sometimes the optics are, that's my money, even though it's really borrowed money. It can be easy to spend. So having a line of credit in general is for people that can manage the credit properly, I would say.
So you're saying buying a new truck like my wife wants is going to be a bad decision with this?
I think buying any vehicle is always a bad decision because it's a depreciating asset. But I haven't found the trick for getting around that one yet.
And I want to ask you, Steve, who would be the ideal candidate for this? Like, what are those criteria where you're like, yeah, you should 100% do this and take on that risk?
A great question. I think those that are paying tremendous amount of taxes in Canada, which is the majority of us. So, if you're in that 50% tax bracket and you have you have some investments and you also have some mortgage, a great opportunity for you to leverage that mortgage of yours and keep more of your hard-earned money. Those that are okay with using leverage as an investment opportunity. The Smith maneuver, if you read the book, it says it's not actually a leveraged strategy, but it is. You are using, that line of credit to invest. And, it's a great one for business owners as well, but it's generally those that want to do better and kind of fed up with giving half their paycheck or more to the Canadian government.
Got it. And we've talked a lot about how someone can go from a traditional, hey, I got a mortgage, to hey, now I have a 2-part mortgage and I'm taking the HELOC, investing it, getting some money back, paying off the mortgage quicker, and also having investments. We talked about the risks of the Smith maneuver too. And really what I want to end this call with is, how can someone safely implement the Smith maneuver? Because it does seem like there are a lot of moving parts. You mentioned, it is important to track a lot of your finances here. Which sort of professionals should an average Joe Schmo like me talk with and engage with in order to start and really, do the Smith maneuver properly and safely?
Great question. I'm always a fan of independent experts. So like Alex, independent, that are familiar with the Smith maneuver. Getting that independent advice is so huge, especially when they're professionals like you guys, right? Ones that, you can have a Smith maneuver accreditation, which is fine. And I applaud to those show that they've got the extra knowledge and they took the time to better themselves. But it's not that complicated of a process. Those that have no idea what they're, if they never heard about the Smith maneuver before, I don't think you should be talking to them for professional help.
I would say mortgage professional, financial planner, and also an accountant, just to run it by your accountant. But all the three key people you would want to pull this off.
Yeah, have your team around you, and that's what I mean by independent. Those that are representing you, not representing a institution.
Yeah, I think that's huge and important. And we talked about the potential benefits of the Smith maneuver, being able to save hundreds of thousands of dollars over the course of decades. But keeping in mind that there is risk with that. Like, the thought from my personal point of view is like, I do want to spend a few $1,000s, like investing in the right professionals to consult with and to help me get into the right products. So that way I can do this properly, as opposed to like, exposing myself to those risks. And so I think that makes a lot of sense, to consulting with those professionals. And I would encourage people as well listening, if you are considering the Smith maneuver, talk to those professionals, reach out to Steve, reach out to Alex, really understand, what your situation is and how to do this properly. Because, hey, if I can spend, $5,000 to $10,000 consulting with the right professionals in order to save $100,000, $200,000, $300,000 on taxes, that is a well worth investment, in my personal opinion. So, Steve, where can people go to find more information about you? What other sort of services do you provide?
Hey, thank you very much for being on here. You can find me at thefinancialengineer.ca. I also got a book, Grow, Control, and Keep Your Money, which has a little section on the Smith maneuver. And I'm based out of Halifax, but have clients all over Canada. So happy to help anyone that helps others.
Got it. That's amazing. And as always, if you need help with getting a mortgage, please reach out to Alex Lavender, and I'll have links for Steve's book and Steve's business and Alex as well, all in the description on this video. Thank you very much for tuning in, and I'll see you in the next video.